The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very good morning to you and welcome to Squawk Box Europe. I'm Juliana Tattlebaum with Steve Sedgwick, and these are your headlines this morning. In an exclusive interview with CNBC, the Bank of England's Greene says the UK is holding up well and that she'd need to see more signs of weakness before backing further rate cuts.
I would need to see the labour market deteriorate more, and that would need to play out not just in the unemployment data but also in the employment data.
The head of the UK's budget watchdog resigned after a report into the early release of the details of the Chancellor's announcement. And Bitcoin, pretty steady actually after posting its worst day since March, with risk-off sentiment hitting crypto-related stocks. How you doing?
Pretty good. It's been quite a market to watch over the last 24 hours, but we seem to say that every day.
I know we do, but I mean, despite the fact that what was the Dow down 427 points, S&P down 36, Nasdaq down 90, concerns about crypto, the truth of the matter is actually the market's pretty sanguine at the moment as well. I know Michael Burry, and we'll talk about this in a few moments' time, he thinks Tesla's ridiculously overvalued. Tell me something we don't know. I mean, it's all about other things. It's not about cars, isn't it? But what I wanted to say is the VIX is only trading at 17. Now, bear in mind, when we got all excited at the peak of the last 2 weeks, it was trading around 30, just under. The fact of the matter is the market seems very, very relaxed, despite the concern that we're seeing in the Bitcoin arena, despite Mr. Burry's worries about Tesla. Actually, at the moment, the market's back into its quite relaxed zone. Although I noticed, I beg your pardon, the likes of silver and gold trading at those highs again.
Oh, you're always keeping an eye on silver, I know that.
What, the great missed trade of the year?
Missed trade of 2025.
It was the missed trade of 2025.
It does feel like investors are certainly watching Bitcoin closely. Investors in equity markets, investors in bond markets. But yesterday, despite the fact that we saw Bitcoin tumble even further, it's now down more than 30% from its peak in October. Equity markets fairly calm. I think also some interesting trade in Japan that certainly got a lot of attention yesterday. With the 10-year yield closing at its highest level since 2008. So certainly there are some hot spots in the market, but by and large, equities doing okay yesterday.
Yeah, look, there is a very big report out from the Bank of England on financial stability, and I will just refer to this now. Again, it's a very long report. There's a huge PDF. You can all find it on the Bank of England's website. I will give you a précis version now. Bank of England Financial Stability Report says risks to the financial stability have increased in 2025. Key sources of risk include geopolitical tensions, fragmentation of trade, and we'll talk a lot about trade a little bit later on with a representative from the UN, trade and fragmentation in financial markets. I think that's really interesting. The FSR, the review says that report says also include pressures on sovereign debt markets. Well, we know that obviously gilts have been oscillating. Biggest UK banks have passed the stress test. Hurrah! I'd be worried if they hadn't. Many risky asset valuations remain materially stretched, particularly for technology companies. We mentioned that at the top of the show. Particularly for technology companies focused on artificial intelligence. Isn't that amazing that this is a financial stability report and they go straight in there talking about AI valuations as well. I'll do a couple more. Heightened risk of market corrections. Judges the appropriate benchmark for system-wide level of Tier 1 capital requirements is now around 13% of our was. There's a few more bits in there. Do you want to go through?
In terms of the AI piece, it is really interesting how prominent it is in the FSR. And to go a little bit deeper here, the Bank of England saying that the role of debt financing in the AI sector is increasing quickly as AI-focused firms seek large-scale infrastructure investment. No surprise there. Obviously, that's something we've all been observing. They go on to say that deeper links between AI firms and credit markets and increasing interconnections between those firms economists mean that should an asset price correction occur, losses on lending could increase financial stability risk. So really an ode to the concern that a lot of investors have been becoming increasingly cognizant of over the last few weeks.
No MPC member will ever say the government's doing a bad job or the government's failed. But when you get statements like this, I'll let you all make your own minds up here as well. The bank capital stress tests indicate the UK banking system could continue to support the economy. I beg your pardon, he's not saying, he's saying even if the economic conditions materially worse than expected. So they're not saying it's worse than expected. Actually, I misread that. They're actually saying that the banking system is well placed to support the economy if it performs worse. Two recent US corporate defaults, I think it's talking about First Brands and Tricolor, show how corporate defaults could impact bank resilience and credit markets simultaneously. There's actually a lot of really interesting stuff in there. Very often these reports are quite dull, but this is actually I think this is actually
upside, I would say.
Yes, and we could spend hours on it, but you wouldn't appreciate that, would you? But we have got a brilliant interview with a Bank of England policymaker. I saw her yesterday. Megan Greene was in the studio talking to Rittiger, told Rittiger that she would need to see the UK's labour market deteriorate more before she'd vote for a rate cut. Speaking in the aftermath of Rachel Reeves' long-awaited budget, Greene said that if the outlook for consumption ends up weaker than the Monetary Policy Committee has been expecting, then it could also shift her views. Now, Rittiger asked Greene about the UK's underlying inflation story.
The labour market has been weakening, and that's something that we've projected, so that's not a surprise. That's what you would expect, given that monetary policy has been restrictive. But it hasn't been weakening faster than we would have expected. So far, most of the weakening has happened in the form of fewer vacancies. More recently, we've seen unemployment ticking up. And that's what you would expect to see. There is a risk that we could have kind of non-linearities, so that you have employment start to tick up very slowly and then all of a sudden tick up very quickly. In fact, looking at the past, that's what usually happens when you have restrictive monetary policy. We haven't seen that in any developed economy in this entire cycle, so it does suggest that it might not work that way this time. And then on the employment front, kind of the flip side to unemployment to some degree, there are signs that there's stabilization on that side. So if you look at vacancies, they've been coming down, they've really leveled out. If you look at underlying metrics of employment growth, they're in positive territory, very weak, but still in positive territory. And when we talk to our agents around the country, they say firms are telling them that the adjustment that they've made to the last year's budget, to the NICs and the national living wage, in terms of how many people they're employing, that's already happened. So the adjustment's largely in the rear view mirror. And so that suggests that the labor market isn't about to face a shakeout that, I had been worried about a year ago, for example. It doesn't seem like that's materialized. And so that gives me confidence that the labor market is weakening, but you're not seeing it deteriorate significantly.
Okay, so what more then do you need to see to then warrant a rate cut? Because you've said that monetary policy, you're not convinced that it's meaningfully restricted. So what conditions would rate cuts be appropriate at? Because if you do look at we talked about unemployment, but we've also seen inflation come off its peak when you look at the PMI. So there is some data showing still some weakening.
Yeah, although I'd say the PMI data has been pretty mixed. So some of it has been surprisingly strong as well. So I would need to see the labor market deteriorate more, and that would need to play out not just in the unemployment data, but also in the employment data. The labor market data in the UK is very difficult to read, so I would want to take a steer from a bunch of different feeds for data to determine that were occurring. And then on the downside, I'm also concerned about our outlook for consumption. So we keep expecting consumption to kick in, and it keeps not happening. And so usually, historically speaking, the UK consumer and the US consumer behave more similarly. U.S. consumption is about 15% above pre-pandemic levels. UK consumption is about 1% above pre-pandemic levels. So there's just been this huge divergence. People aren't spending, they're saving. We keep expecting people to spend as interest rates come down. If the outlook for consumption were to end up much weaker than what we're expecting, then that might shift my views as well.
So I want to talk about this consumption conundrum, as you've called it, in UK households, because that household savings ratio is just so high compared to other countries, as you've mentioned, but also historically here in the UK. Why is that we're seeing such high household savings?
It's a puzzle, and particularly if you look at the survey data, it's not coming out as you would expect. So, for example, as unemployment is rising, usually people, when they know people losing their jobs, they start saving more because they're worried about their own. But when we ask people why they're saving, the percentage of people saying they're saving more because of concerns about the labor market hasn't changed, even though unemployment has been ticking up. So that's really strange. So in my view, it could be one of two main reasons why people are saving so much. One could just be scarring, right? We've been through a few crises. We've had a few successive supply shocks that we're not used to. So people might just be saving for a rainy day instinctively. In that case, the monetary policy response isn't totally clear, though, because in that case, if you want to unleash consumption and boost demand, you would actually just work really hard to get inflation to target as quickly as possible to make sure that people know that we're serious about our target, we will hit it, and then they'll feel more confident spending. So often you think if you want to boost demand, you have a less restrictive stance. That's not the case if the reason is scarring. There's another potential reason, which is the structure of the mortgage market. So with people on 2- and 5-year fixes, even though rates have been coming down for over a year, people's mortgages are resetting at a higher rate. So total debt service ratios are actually still rising instead of coming down, which just means we might have to wait for a bit longer than we're used to for lower rates to actually feed through into consumption. But the monetary policy responses to these two potential causes are totally different. And so I would like to see more on what's really underpinning such weak consumption.
I let into a little secret. I knew about her answer to that yesterday because I was here I was doing a different interview. I am unbelievably fascinated by that interview and by a monetary policy committee member talking about savings rates.
Yeah.
And she was saying, it's a bit of a conundrum. As rates come down, people tend to spend more as well. But I think Megan Greene answered her own question there as well. It is not actually a conundrum. It is incredibly sensible. And for once, the British people are doing what they should be doing in a period of uncertainty. They aren't spending. The rates are extraordinary. And young Matthew, who's our brilliant producer in the gallery today, has just sent me one of the latest charts on UK savings rate. Now, throughout my life, the UK has been rubbish at savings. We love spending stuff. We like the Americans, as Megan Greene was pointing out there as well. But the savings rate now is somewhere in the region of 10%. Which is huge by historical standards for the Brits. I mean, of course, there are COVID anomalies, but by and large, in a normalised cycle, the Brits don't save 10%. They're saving 10% because they are terrified about the economic situation, because they are worried about their economic well-being. They may not have friends and family who are losing jobs. Again, just concurring what Megan Greene was saying. That's great, brilliant. Thank you. What a chart. And that just really, really shows me. Look at that. Where are we going back to? 2023, we were 4.7%. Now, when by and large people are still keeping their jobs, we're saving twice as much money, despite the fact that interest rates are off the top. And it's because people don't have confidence. Yeah. Confidence is everything. Yeah. It's everything for a household. It's everything for my willingness to go out and spend money. It's everything for companies, you lot out there, to go and spend on plant, on extra employees. And it's also confidence for the other lot of you lot watching, which is your investors, who will not put money in the stock market if you are concerned about taxation changes, regulation changes, or actually you're just worried about the economic well-being of the investment you're putting money into.
Yeah. I thought the color she gave was fascinating and really, really insightful, that it's not because people are worried about their jobs in particular, but also the follow-on to that if part of the reason that people are saving more is because they're scarred from events of the past and they want to put away money for a rainy day, the answer is not necessarily to make rates more supportive. It may be to make rates more restrictive, because it shows that you are committed to fighting inflation, which is obviously a primary driver of cost of living going up. So I thought it was really interesting color to hear a little bit more about why people are saving more and how the Bank of England may look to resolve it and get people to feel more confident again.
Sure. And the Bank of England can't really necessarily do that.
No, it's not necessarily their job either.
100%. Mike Cooper's Chief Investment Officer at EMEA at Morningstar Wealth. Mike, good morning to you, sir. Thank you very much indeed for joining us. Do you concur? People aren't saving, people aren't spending, people aren't investing, people are saving because they are really, really concerned.
Well, the major points made in that last interview illustrate exactly why that's the case. The number of shocks we've all been through over the last 5 years. I think the speculation about the budget also showed up, and people pulling money out of their pensions because they're concerned about what could happen. So we've been in a situation of significant uncertainty. And it's perhaps not surprising that the result of that is savings have gone up. But savings going up, actually, there is a silver lining to that in terms of creating a degree of robustness, a capacity to be able to deal with future shocks. And that's a good thing.
In terms of the ability to deal with future shocks, we just got the latest financial stability report out of the Bank of England, and the headline is that risks to financial stability have increased during 2025, and pretty near the top of the report, they mention AI equity valuations in the U.S. close to the most stretch they've seen since the dot-com bubble, and the fact that this heightens the risk of a sharp correction. What do you make of the fact that the Bank of England has chose to highlight that so immediately in their assessment of financial stability here in the UK?
When you compare the report to the previous one, many of the messages are very similar. So the biggest change since the last report has been how this AI spending has been funded. And certainly the circularity is one thing. The debt is a new feature. These companies previously funded their expansion from free cash flow. They're now having to do it from a combination of debt and effectively selling equity in their business or hookups with their clients or suppliers. So it's a new development. Is the amount of debt so large that it's suddenly really a fundamental risk to everything? I'm not so sure that's the case. Many of the issuers have pretty pristine balance sheets. But I think it's fair to say that it marks a change in the riskiness of how the AI spend is being funded. And ultimately, if it continues to grow, that will have broader financial implications. So they're certainly right to pick up on that. But it's not as if today this is a colossal amount of debt relative to the system and relative to the balance sheets of those issuing the debt.
That's a really, I think, important point. And to me, that's what stuck out as well. The fact that right up toward the top, they talk about the deeper links between AI and credit markets, and the fact that so many of these firms are now funding their massive investment via capital markets and not necessarily from cash on their own balance sheets. At what point does it become a problem, though, when you're thinking about investing here?
I think the key thing for investors is to recognize two things. Firstly, because of its outperformance for many years, the US has become a really big part of people's portfolios. And the second thing is the US itself has become very concentrated in a small number of big players who are all tightly linked to each other and linked to this AI theme. So what that rings out as alarm bells is your portfolio just one big bet? Should you be thinking about having other sources of risk and return in your portfolios? And that's been a key focus of how we run our portfolios, to identify things outside the AI sort of world, as well as outside the US. So that's the key takeaway for investors. It doesn't mean that these aren't ultimately good investments or good companies and that there won't be a good return on investment. But when the share prices are high, when these are big parts of your portfolio, and when they're all interconnected, you need to think pretty hard about your asset allocation and your diversification.
Mike, where can you diversify where you're not going to have that same oscillation in your portfolio?
So there's three levels you can think about. The first is your asset allocation. For us, US government bonds and government bonds in general still are a great diversifier for equities. And with interest rates being fairly high for quite a period of time, that is having an impact on inflation. So we think that's the first line of defense. It's high quality bonds. There's also currencies that you can bring into play, which are safe havens. We think, for example, that the Japanese yen is a good example of one of those safe havens. So that's the first thing. The second thing is to look around your industry diversification. So whilst it's true that AI has spread its tentacles into a variety of other sectors, the consumer discretionary sector, and even some of the utilities, there's still good quality growth and defensive assets outside of that. Consumer staples and healthcare are two examples. And the third is looking geographically. So in the past year, some of the investments we've held that have done really well haven't been tightly connected at the start because they've been such distressed, low-priced assets. Korea was one and China was another. More recently, Brazil and Mexico. So there are opportunities outside that sphere of influence. Even there, though, it's fair to say any company which has been directly involved with OpenAI, for example, its funding, whether it's Samsung or SK Hynix, has been caught up on this. The Chinese players are on a parallel ride, but they're not directly linked. And so there's probably greater diversification, at least in China, even in the tech place.
All right, Mike, thank you very much indeed for joining us. Very, very good to catch up with you once again. Mike Coop, who is Chief Investment Officer, EMEA at Morningstar Wealth. Well, coming up on the show, ridiculously overvalued. Big short investor Michael Burry taking a swipe at Tesla, slamming the company's giant valuation. Plus, Nvidia snapping up a $2 billion stake in chip designer software maker Synopsys as it tries to fend off competition in the AI race. And more from our exclusive sit-down with the Bank of England policymaker Megan Greene as she lays out her targets for the coming year. That's coming up in the next hour of Scorebox. Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's Miss Jo Malone, CBE.
I started that first business of skincare. That's when I knew that I was in charge of my own life. And that's when the entrepreneur really, although I didn't know what the word entrepreneur meant, that's when the entrepreneur really took hold.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Welcome back to the program. Well, yesterday was a downbeat session for U.S. equities. We saw all three of the major indices retreat in the trade. We saw the Dow pull back about 0.9%. The S&P lost about 0.5%, and the tech-heavy Nasdaq slipped as well. U.S. markets breaking a 5-day win streak. We saw the losses driven by the utility sector. That was the hardest hit in the United States. Also worth noting that we saw yields move higher across the globe, in particular on the back of the Japanese bond market sell-off, where we saw the 10-year JGB yield move to its highest level since June 2008. We'll talk more about that later, but just bear in mind that we saw yields move higher as U.S. equities came off. Now, artificial intelligence, certainly a key topic these days. It's now mission critical, and a vast majority of firms are seeing positive returns on investment in the new technology. That's according to a new report by FinTech FNZ, which surveyed more than 500 financial institutions and found more than 70% of financial execs think AI will be critical to the future of their business. Roman Regelman joins us now, Group President of FNZ. Roman, great to have you with us. Give us the key takeaways from this new study that you conducted. What will be new to our viewers?
Yeah, good morning and happy to be here. So it's exactly as you said. It's a comprehensive study on artificial intelligence in the wealth management industry. The entire industry is $200 trillion of assets. This is trillion with a T. This study covered 500 institutions, representing 40% of the market. So that's $80 trillion. Three key studies. Number one, the finding number one, artificial intelligence is not a nice to have. It's an imperative. 73% of executives feel that's something that's going to differentiate their firms. Number two, despite all the talk of the bubble, the returns from artificial intelligence are here and now. 90% of executives feel they're realizing returns in their firms from artificial intelligence and wealth management. And number three, maybe the most interesting one, human advisors, the advisors helping people in the street to lead their financial lives, are here to stay. They're going to be empowered by AI, they're going to be augmented by AI, but fundamentally people believe that advisors are required.
Roman, fascinating report. But to go from nice to have, or not just a nice to have, it is mission critical. But I keep hearing the same comment back from people who are in the industry and trying to give companies AI strategies, that a lot of the companies, they know it's mission critical, but they don't know how to put it into their broader infrastructure. And when they do put it into their broader infrastructure, they don't know how to tie up various parts of their business into one cohesive AI strategy.
I think that's exactly right. It's a power of the network. What we do in FNZ, we are a platform. We power the largest wealth managers in the world, like Lloyd's, Aviva, Raymond James, Bank in Montreal in Canada. And it's a platform that connects advisors and customers, organizations themselves. It has data, and AI on that platform is something that actually creates the results. AI by itself in isolation is not an answer. AI is part of the technology platform that provides software, operations, and market access. That's what creates the results.
There's another line in your report which I find very interesting, because MIT, as you well know, said 95% of companies are failing to really monetize an AI strategy, and yet your report says a vast majority of firms are seeing positive returns on their investment as well. So I'm struggling to marry those two very extreme scenarios.
The positive returns come from early adoption of AI. AI creates new products. AI helps with operational processes. Take this advisor that I just talked about. This advisor spends a lot of time on administrative tasks. They spend a lot of time on obtaining data, disseminating data, sending reports. All of that can be done by artificial intelligence. So they can spend more time with the end customer. They can think more about the products. The other thing that AI does, it allows access to the products that people could not get access to before. The products that were only available for a few. Now, with AI, with modern technology, through data and this network, it actually comes together. So that's where the return comes from. It's investment of AI, it's investment of data, investment in a platform and technology that underlines that.
Roman, where are we in terms of the investment journey among the companies that you surveyed? It's a little bit, you hear that financial institutions are investing, but it's a little bit hard to gauge where in the investment journey they are, how much they've already done, and how much there is to go in terms of investing in AI.
I think it's about investment in technology. AI is a type of technology that's here now. We're obviously talking about AI bubble, but fundamental underlying technology is here to stay. We may see some companies come and go, but what's most important here, when you have a technology that connects the entire ecosystem, you have the power of the network. That's where we're realizing returns. So I think the investments will continue, but I think the early adopters will absolutely be generating good returns.
Roman, I was a pit trader in the 90s, and we knew sooner or later technology would take over our role. In fact, it just takes one person to press a button rather than a whole series of brokers and market makers to facilitate a trade. In the same vein, I ask you, why will advisors not be replaced? And I say this because I know there's a lot of financial and wealth advisors watching. Why on earth will they not be replaced by technology that can do deeper and more extensive analysis and come up with the same investment scenarios, if not better investment scenarios? I just wonder why we're going to need humans.
I think that's an excellent question, because advisor is not just about financial instruments. It's about trust. It's about confidence. It's about emotional intelligence. So you're absolutely right. Like in the 90s, advisors will have more data in their fingertips, information will come quicker, the client themselves will be able to see the reports and see markets around the world. But the power of advisor will come in guiding the client towards their decisions, thinking about their financial life comprehensively, not just assets with this particular institution. So much like your example in the 90s, the data will be there, technology will come, but the power of a human amplified by artificial intelligence will only increase.